Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 9th of December. I'm Daniel Lam, your host for the podcast. The markets have well priced in a 25 basis point rate cut at the FOMC meeting this coming Thursday. The question that many are asking now is whether we will have a dovish or hawkish press conference. Well, looking at the recent set of data, we may get a dovish tilt there. In a nutshell, labor momentum has stalled and fragile consumption limits inflationary pressure. The delayed September personal income and outlays report was weaker than expected. Nominal income and spending beat estimates, but real spending was flat. There is mixed picture in the more recent and forward-looking data as well. The November U of Michigan Consumption Sentiment Index beat estimates, with the headline rising to 53.3 from 51, as lower inflation expectations lifted the expectations component. But there was deterioration in the current conditions. So this means spending and consumption lack a bit of momentum and slowing with weaker employment, which is typical in a low hiring and low firing environment. Thus, it is possible that there's more scope for Fed easing than is currently priced. Leading indicators show limited inflationary pressures outside tariff, and tariff-driven effects seem to have peaked in both goods and services. Combined with labor market softness, there are chances where the Fed may bring the Fed funds rate closer to neutral, which is at 3%, if there were to be further weakening in labor conditions. A very important point for 2026 is that Trump is likely to be appointing a dovish Fed chair, and 2026 is the midterm election year. Now, historically, that can be volatile. Since the end of World War II, the intra-year drawdown for midterm election years averaged 18%, which was the highest of all 4 years of the presidential cycle. Moreover, the S&P 500 experienced the weakest average annual price gain at only 3.8% and rose in price only 55% of the time. That's compared to an average gain of 10.8% and 76% of frequency of advance for the other 3 years. Therefore, there can be a dovish tilt at the FOMC press conference, and that can lend tailwind to DM government bonds. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.